Hello, Avila Advantage Macroeconomics students. We are now in our final week, so congratulations to everyone. You've made it through the course almost. This week we wrap up with your final readings in Chapter 30 and 31. You'll have your weekly quiz. We have a forum discussion out there for the forum discussion this week. I tied it to Chapter 30. They had a little section in there about the question about Social Security and Medicare. It's one of the big things that are looming of concern, not necessarily now, but they do know years down the road. And the textbook authors put out some potential solutions. So what I'd like you to do is kind of jump in there and give your value judgment or opinion about what should be done. Again, however we do it is going to impact some other party. So, and also take into consideration, this is a part of fiscal policy about how the government spends its money. And if you maybe take away from one group, how is that going to impact the overall economy too? So do some research, see what you find out there relative to what other people say about that, and post your thoughts by Wednesday. And then again, we have our final, so just make sure to get that completed before Sunday at midnight. And just look forward to talk to you online. So with this week, first off with Chapter 30, to kind of go over some of the key ideas in that chapter. It does start off and talk about, our government at the federal level and state and local level do spend a lot of money. They obviously collect money in the form of taxes. They don't cover enough in taxes, they have to borrow money. But a lot of this chapter first starts off in just what are some of those expenditures. And actually from the state and local level, in dollar amounts is almost equivalent to the federal level too. So we do have a lot of different spending from the public sector. And they spend on various things from national defense to highways to education. So, and as we pointed out, Social Security and Medicare, and that makes up a big part of it. But the chapter also addresses the question, how should we spend this money? Again, what is important to us? How does this lead to future economic growth? And they have a little bit of a, the debate too about how we should spend it. Even locally here on the Kansas side, there's a lot of debate right now with higher education. Also just high school education, grade school, about how we should have equality with the expenditures of this money. Who gets what is a question a lot of times. So, and in order to raise this money, we have to have taxes. The chapter also talks about the different types of taxes. There could be a progressive tax, that is, the more income you make, the more you would pay as a percentage. There are some income taxes that may actually be regressive, that is like a sales tax. If you only need to buy so much food per year and you pay sales tax on food, well, the higher your income, the less the overall percentage that tax is on you. But if you're at a very low income level, that food sales tax has a bigger percentage of income impact on you. There's also questions we'll look over this chapter about debt relative to GDP ratios. Debt is something that we've been seeing increasing over years. Obviously, after 2008 and the subprime crisis crash, the government had to take on more debt to try to get the economy stimulated. But how much is this a percentage of overall GDP? Is there a point that it becomes too large? And for right now, that's still much of a debate about how much is a good amount. There's no right or wrong answer, and you'll hear different economists have different reasons why they feel that it is important or is not important. All right, our last chapter, Chapter 31, it talks about, in this one, we kind of have on this side the kind of the savings versus the demand for that. They put it in terms of investment, and they rearranged the equation algebraically. That there's going to be some impact of investment from private savings, from the difference between exports and imports, and finally the difference between what the government collects in taxes and what they spend. And for the most part right now, the government spends more than what they take in, and we do have trade deficits, so that money has to come from somewhere, and that's mostly from foreign capital. That's, for right now in the United States, we've been able to attract foreign capital, and if that ever changes, we will not be able to continue our current levels of spending. We'd have to cut back, but probably because of the safety and the liquidity of investments in the United States, which consist of treasury bills, treasury notes, or treasury bonds. Bills go up to 1 year, notes up to 10 year, and bonds up to 30 years, 10 to 30 years. People feel relatively safe, so we'll probably always continue to get that money coming in. Other places in the world, maybe perhaps like Venezuela or other countries that are suffering right now. Even China, you see money moving out there like a school of fish. They're parking their money somewhere safe. So when they're buying U.S. dollars, if they're investing in U.S. assets such as treasury bills, notes, and bonds, or buying in the U.S. stock market or buying U.S. corporate bonds, they're parking their money somewhere what they feel is safe. So a lot of this chapter also looks at the issue of fiscal policy, whether they can impact aggregate demand. One of the big concerns in this chapter they talk about was crowding out. That is, if the private sector, we go all the way back to think about the aggregate expenditures approach, where aggregate expenditures equals C plus I plus G plus net exports. Well, the government could try to stimulate the economy by shifting the aggregate demand curve out, but if interest rates go up and the government has to pay a higher interest rate to attract that capital, they may actually crowd out the private sector. So that could result in less investment by, say, private companies, large companies like IBM or McDonald's or whoever it would be. And that could actually shift the aggregate demand curve into a degree. So if there was full crowding out, the government's attempts to try to increase the economy is actually exactly offset by the decline in investment. Partial crowding out would just mean that some of their attempts to try to stimulate the economy may not have the full impact. And one of the last things they mentioned in this chapter too is that if we do run budget deficits and there is that attraction for foreign capital to come into the United States, we want to get paid in dollars to buy that capital, so that could drive up the demand for dollars. And as we drive up the demand for dollars, that could also hurt trade deficits, because now from an exporter's perspective, our goods would look more expensive as the dollar appreciates. So it's, they also discuss in this chapter some of the trade-offs of running budget deficits. So, well, that's it for the week on the concepts. Do email me if you have any questions. Otherwise, I look forward to hearing your thoughts in the forum discussion this week. But I want to say that I've enjoyed working with you all this semester, and good luck to all of you in how you apply your macroeconomic decisions to micro decisions, or at least I hope now that you have a lot better understanding of the macroeconomy and how the big picture works together. So take care and have a great week.